Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good weekend, everybody. It's Ira Epstein. It's the end of trading on Friday, the 16th of September, 2011, about 3:40 in the afternoon. Glad to see some of this volatility on this week get behind us all. Stock market had a pretty good day. Nice little rally here. Bonds and notes rallied as well. And the gold came back $31. But as you're going to see, this gold just ran into a resistance point that hasn't turned the corner. Copper still, if you will, probing the 385, 395 zone in the marketplace. Okay, it's probing an old support zone. And silver's trying to rally up a little bit, but I don't know that it's going anywhere. You cannot forget several things. Going into each weekend right now, everybody's scared because you don't know what shoe's going to drop out of Europe. The second thing that you have to keep on your magic mind is that this week the FOMC meeting takes place, and it's a two-day meeting, not a one-day meeting, and the markets are anticipating stimulus, some action by the Fed, some change in the balance sheet, what they're buying, something to happen. The president's bill has fallen flat. If you don't realize that by now, it's time that you do. He's had a week and a half opportunity. Nothing has happened. Jobs data still stinks. If you're looking at economic indicators, they stink. And under the surface, maybe in time things will get better. But the question is one of time, because he has an election coming up. And having a 9.5%, 9% unemployment rate historically hasn't done well for the president. So I'm expecting that somewhere along the line we're going to see something, and I think the market is betting that the Fed's going to pull something out of its hat this meeting. The market's certainly expecting it. So gold, it's been in a correction mode, but as I've pointed out to you, it's still stuck between 1705 and let's call it the 1910 zone for all purposes. The market's pattern, well, the chart pattern by itself is bearish. Whoa, I know you don't expect me to say that, but it's true. Lower highs and certainly lower break lows all the way through. That's not good. Now, the recent low, just this one, has taken out that 1794. This low did not take out that one. It just began when you took that out yesterday, Thursday. You followed through to even a lower low today. For regular viewers of this video, the one thing I try to point out is without a swing line study on your chart, this is what it looks like. This is clear what it is. You can even widen it more so you can see it clear as can be. What's the risk factor in being short? Not to get over 1848.20. So that's one of my lines in the sand. What else do I look at? I look at the red line, the 18-day moving average of closes. And when the market is under it and has sell signals, that is a potential resistance area. Today's high was 1825. That 18-day average was 1822. People that sold that went home with a profit of about $10. The danger, of course, is going home with the position. I'm the first to tell you that because of the terrible uncertainty that we're seeing out of Europe at this point in time. If the market were to break lower, the interesting thing is instead of moving averages above the market the way you have in the stock market, you've got them below the market. So one of the averages, the 45-day average of closes, is 1741. The 100-day moving average of closes, way under the market at 1623. I would guess if the market fell apart, that would be what everybody would center on. I'm not expecting the market to fall apart. I'm expecting somewhere between the 45-day average of closes and the Bollinger Band, which is 1754, that the market, if it probes further downside, that will be where the support is uncovered. I think that if the market were to take out 1848.20, it's not just going to pick up and run dramatically to the upside because I see the Bollinger top falling down. And if you take a look at these bands, they have a good way of trying to halt a rally. Do they always do it? They do not. You get up and you could see you hugged it here. Now, staying over the Bollinger Band more than 4 or 5 days, rare, rare, rare. I haven't seen it in gold. I've seen it in the Dow Jones, but I haven't seen it in the gold. And by the way, the first time I ever saw it was just recently in the Dow Jones on that big August break. I'd never seen it, and I went back and checked my research, and I couldn't find it in the when that's the active traded contract. So Can happen, I guess. But I'm still looking for that to be the case. I think you realize my bias is to the upside. The bias to the upside comes in for a number of reasons. Number one, the market is quickly approaching an area where if it drops again, it will get oversold. That would tie in with the 1754. The key is you don't want to be a bottom picker. I find that people that pick tops and bottoms, well, sometimes they guess they can do well, right? But the odds of it are very small. I think trend trading is the way to go, whether that's shorter-term trends or longer-term trends. That's up to you, but that's what I think. And I think the longer you go out on some of these charts, the more bullish they get. But we are in a corrective mode. Now, the interesting thing about the corrective mode is the seasonal studies are up at this time of the year. And most of the seasonals, I was just looking, kicked in around the 1830 area. That's where the market was. So the seasonals are behind. On average, over a 15-year period, they've made money. But, you know, today's moves are $30 moves. I don't know that history's used to the volatility we're seeing in this market. So while I believe in the historical trend, I'm not certain that you can count on what the old historical moves were in terms of profit or loss. In the silver market, I'm just as bearish as before. The market, however, is clearly oversold. You got a 26 reading in the stochastic. Resistance, 41.20. Wouldn't want to see the market over 41.41 if I were a bear. And if that occurred, I think you got to jump back into the bull camp in the market. And in the copper market, well, you know what I've been saying. I think the market's going to lay down against the Bollinger Band because it's in a downtrend, bounce away from it, and try to figure out what next. You are oversold, not even close to an embedded stochastic here, which would mean that the market has turned from being an oversold to locking in a bear trend. Nah, you're not even at the beginning stage. And you've been here before. You've been in these 380s basing, so you're testing the lower end of a previous band of price. And the market's caught in a band, let's call it the 384 area up to the nearly 425 area. It just seems to be caught in there at this point. But the bias to the downside, unless you get up and over 402.45, at which point you negate that. Before I get too far, my futures trading kit, I think it's important. It includes my oral and written recommendations. I don't care if you're a beginning trader or somebody doing it already. You download this. I make it look like a CD so you can see it, but it's a download. It includes the charts you see me working with, and many, many more studies. Then you get access to my recorded webinar. This is a video. We call that a webinar. It's very tightly controlled. It's by subscription. If you've not tried it before, we make it available so you can try that out. And all the features that are in the kit, from all the different studies we have, the books on options that we write, market research. There's a tremendous amount of daily research that flows right through the charting software. It's yours to try for free. If you haven't done it before, and it's just done by giving us a phone call at 1-866-973-2077, or go to our website, www.iraepstein.com, so you can sign up for the kit right there. All right, let's get back to the chart action, and let's go to the next chart, which is the crude. Now, the interesting thing about the crude is this market is for the first time falling, and the stock market's going up. And I haven't seen this breakaway in this relationship for a couple of months. If you go to my other video on the market area, you'll see. I bring the chart up there, and you can see how clear that is. But you're still in an uptrend, but in overbought territory. Your stochastics are turning down. That means the odds were favoring that we'd get to the 18-day average. Well, you're already there. So this market has to work itself out of that until it takes out 8,500. I favor the bull side, but I don't like the fact that the market's in overbought condition. Where the action is happening is in the Brent, the world grade. Look at how it took off. And it's got a consistent pattern of higher lows, and it's got the higher highs. So I'm looking today for resistance at 116.30, the Bollinger top. Missed it by 20 points. Okay, but the support's been 112.60 with a stop out, reversal possibly. That's up to you if you had gotten under 110.80. That didn't occur. The guys that bought the 18-day average have been rewarded with this pop late in the week, and the market has held a pattern of higher highs and higher lows. Bravo for them. In the Brent, not in the Brent, in the Rebob gasoline, you're not in a downtrend anymore. You're neutral. Prices are fighting it now. The 18-day average have closed. The last chart pattern is a lower low and a higher high. This is the beauty of working with these swing lines. You get to see this on a chart, and it's fun. In the note market, you've rolled over. You're in the bear camp right now because you've got a higher high, but the last action was this break low, took out that one, and you're still under the 18-day average of closes. Would it be a good play? You know, I don't know what's going to be a good play in front of the FOMC meeting. That's going to be the wild one. What do they do? And if they do something, what is the impact on the market? I think that if they don't do something, the stock market won't like that action. If they do something, how does it impact interest rates? Because the goal here is to get employment going, right? And to get employment going, you're going to have to lower and keep interest rates low. Now, the front end's already low. It's the back end that they're probably going to target. And in some manner, the Fed has to create a stimulus for employers to start hiring. It'll be an interesting week, I promise you. I'm Ira Epstein. Enjoy it, and I'll see you on Monday.